Hey, JJ here with the Art of Value. So, big news today, of course, you would have probably seen the market. Big news today is the Fed raises rates by half a percentage point, the biggest hike in 2 decades to fight inflation. That's the headline, CNN, if you're on audio, not video. Video, of course, is YouTube and Spotify. So, the Federal Reserve, or you'll see actually first, you'll see the market really rocketed on that news. Big pop in the market. There's the heat. We're looking at the heat map on the screen now. Everything green, green, green. Apple popped 4%, 4.10%. Netflix, so the big mega caps, unusually, it hasn't happened for a while. Netflix up 2%, Microsoft up 2.91%. Amazon 1.35%, Google 3.76%, Meta, Facebook 5.37%. So these are big moves for these big mega caps. I mean, the amount of money that's gone in to move stocks like that. It's not retail investors. So back to the actual news. What made the market pop that much? I think it was kind of a relief rally. Actually, before I go on with that, I just want to make note of this one tweet by Value Stock Geek, which is is worth noting when we talk about macro and interest rates and all that. Jerome Powell doesn't know what his next move will be. You certainly don't know what the next move will be. Even if you did, you can't predict how the markets will react. Why waste your time with this? Which is kind of there's definitely some truth to that. I mean, investors like Buffett say that he doesn't, and Munger say they don't really worry about the macro. They don't know what interest rates will do. They're just looking at individual stocks, individual companies, not stocks. The businesses, the underlying businesses, not worry about the market. They do concern themselves with how much each company is worth. Having said that, they do buy at times when the market has gone down the most, just because that's when the best deals present themselves. So anyway, back to the Fed. The Fed Reserve increased its benchmark interest rate by half a percentage point in line with market expectations. There was some conjecture that they were going to go higher than that, like maybe 7.5 or even 6.5, something like that. It's just more than half a percent, just a signal that they're willing to do whatever it takes and they're willing to go higher than 5. So I think the relief rally was based on the fact that they didn't do that, and Jerome Powell was he did have firm plans. I mean, the key points are, in addition, the central bank outlined a program in which it eventually will reduce the bond holdings by 95 billion a month. The rate move is the largest since 2000 and is in response to burgeoning inflation pressures. So Fed Chairman Jerome Powell underlined the commitment to bringing inflation down, but indicated that raising rates by 75 basis points, 0.75%, at a time is not something the committee is actively considering. So I think it's that statement that really kind of made the markets rocket. That they're not willing to go 75 basis points. They'll probably go 0.5 at the most and see how it goes, kind of thing. And that, I think the markets have priced in, the rate right. So they've got this sort of more clarity about what they're going to do. And so that stocks rocketed. But still, keeping it in perspective, keeping the macro, the markets into perspective, we've had, the drawdown on the Russell 2000s, 25, before this was 25.4%. The low from all-time high, the Nasdaq's 24%, and S&P was 15.6. So these are, we've had, and it's been the worst start for the year for the global aggregate index in 2 decades. So the worst start for the year in 2 decades. So, and just to finish this off, I just want to make this short. To underline that, this was just yesterday before this happened. So the market got excited today, but Paul Tudor Jones says he can't think of a worse financial environment for stocks or bonds right now. So this was a story on CNBC yesterday. The key points being, Jones said that the environment for investors is worse than ever wait, let me say that again. Jones said the environment for investors is worse than ever as the Fed is raising interest rates when financial conditions have already become increasingly tight. You can't think of a worse environment than where we are right now for financial assets, he said on Tuesday. Clearly, you don't want to own stocks, bonds and stocks, Jones said. So those are the kind of key points that were out yesterday. So this, he's a billionaire hedge fund manager, and he is known more for trading than sort of long-term investing, I think. I haven't researched him completely, but I do know he's sort of an expert trader, made some really good trades. And so that's what he thinks at the moment. And I think it's worth, I'm just going to play a bit of a video to finish off to see what he actually said and just his tone and what he said about the year so far and the environment that we're in here. So here we go.
Within 2 or 3 days. Now, all of a sudden, we've got the same kind of reaction in the markets, which is clearly a risk-off. Credit spreads have blown out. Stocks are down 13% in the year. The dollar's up significantly. All that normally has provoked or evoked a Fed response of cutting rates, and yet we're probably on the cusp of 200 basis points of rises in rates by mid-September. So it's uncharted territories where we're going. And
but do you look at that, Paul, and say to yourself that a recession is coming? Do you say everything's on sale, I got to buy things? Do you say that I got to short this market? I mean, I know you say you don't have a strident view, but you must be telling
look,
the traders
clearly
to do
you
something.
don't want to own bonds and stocks. You start with that. It's going to be a very, very negative situation for either one of those asset classes, right? You can't think of a worse macro environment than where we are right now for financial assets. And again, one of the reasons, I think maybe the biggest differentiator between now and those other periods over the past 40 years is look at the level of overvaluation that we were both in rates as well as stocks. So that's one reason why even with this tightening in financial conditions, the Fed still probably has to raise rates to get inflation under control. Heck, we had CPI greater than 8%. Maybe it comes down to 4% this year. Maybe it comes down to 3% if they stay the course and stay tight in 2023. If you've got inflation greater than 3% on average, your purchasing power declines, cuts in half.
Okay, so that's the situation. He doesn't see it as a good situation going forward because they have to raise rates to get inflation down. And he goes on to say that it can take some doing, and he looks back to the 1970s when it was really actually hard to get inflation down. And Paul Volcker actually, at the end of the 70s, put rates up really high, and inflation, it caused a recession. It was sort of like the recession we had to have, and it did get inflation down eventually. But he sees it as a similar situation, and it's a bad environment for stocks, even though we've had this, there's a relief rally where people say that it's been priced in, the rate rise has been priced in, it's a bit of relief, but we don't know. We don't know what's going to happen. And again, it's I don't know anything about the macro environment. Just, I think it's better to look at individual companies. It does seem clear that there are a lot of like those innovation stocks and tech companies that were overpriced, high multiples that have come down because of this, and that a lot of people just did not see that coming, especially new retail investors. But it's sort of it's not surprising really. Anyway, so that's all for today. Like and subscribe, and follow on Twitter, The Art of Value, and follow on Spotify, and hit the notification bell, Spotify and YouTube if you liked this and want to get notified of more. Okay, thanks. See you next time.